taxes don't magically happen. Taxes are a reaction to your actions.
It's more about, look, these are my pain points. Yes, I want to lower my taxes, but how can I do that in a way that builds wealth?
Welcome, everyone, to the Tax Mastery for Solopreneurs show. I'm Sam, and I'm joined here by Daniel Sleep, CPA and certified tax strategist, and Camilo Rojas, our senior tax advisor here at Oak and Shield Tax Advisors. If you're a mission-driven solopreneur making anywhere from 175K to 20 million plus in your business, and you want to learn the exact strategies we've used to help save our clients 4.8 million and growing in taxes, you're in the right place. In today's episode, we're going to be talking about how the tax-savvy solopreneur, the one paying little to no tax, thinks about taxes differently, and the mindset shifts you need to stop overpaying. So we're going to be covering the 7 tax mastery mindset shifts that can help you legally keep 20 to 100,000 plus in your pocket every single year. Quick disclosure for the podcast, every situation is unique. This is education, not specific tax advice. All right, let's dive in. Daniel, Camilo, since it's our first episode, why don't we start with the introductions and then we can jump in.
Yeah, absolutely. I'm Daniel Sleep, CPA, certified tax strategist. We've been doing this for several years now, and I was in Las Vegas years back, but the last 4 or 5 years we've been on the East Coast, which is nice. And we just realized we really enjoy working with business owners that are defined as solopreneurs. We do have clients that obviously have employees, and we do like working with them as well. But there's a real uniqueness to solopreneurs, especially when it comes to just your ability to mitigate your tax and build your wealth. And you're given a lot more autonomy and flexibility because you don't have to necessarily share specific benefits with your entire team of employees and things of that nature. So you're in a very unique spot. And that's what we've really honed in on, creating a course and also just focusing more, almost niching down on solopreneurs. Even I would say some of our business owners that have employees, a lot of times they will utilize an aspect of being a solopreneur, like carving out maybe a management structure and then having their teams and employees on a different structure. And that we mainly encourage that if they're looking to diversify and have several businesses. I wouldn't suggest that for just maybe one business, because that could look like to the IRS that you're just trying to isolate all the benefits that you can get within your one structure and not give it to your employees. So we want to avoid stuff like that. But there's always aspects of the solopreneur approach to build wealth and mitigate your tax bill in that way. In a nutshell, when it comes to what we offer and what we're doing, and then married with 2 very energetic boys, 6 and 8. I think that's about it. Camila, you want to talk about yourself?
Hello, my name's Camilo Rojas. I am the senior tax advisor here at Oak and Shield Tax Advisors. I am that kind of person that really enjoys tax. Today I woke up and one of the first notifications I had in my email was regarding a revenue procedure that just dropped instantly. I was very curious to read it. It's about 60 something pages, so I haven't gone through all of it, but it's some exciting stuff on how to handle the changes to Section 174, which is R&D related. And there might be a couple of returns for us to amend there. I can see Daniel's face like, I didn't even know this was out.
That's why you're here, Camilo.
That's why y'all make a great team.
As time goes on, you realize only one person can only do so much. And the more you grow the team in the specialization, the more you want to be able to leverage people that have a natural ability. I actually found Camilo through a common friend. So we have this tax professor at FSU, and I had asked him students that at the time, I think I was just looking for a first year tax associate. And he was like, yeah, nobody comes to mind that really strikes out as someone that would really be a good first year for you. He was like, however, a few years ago, I had a student that I knew wasn't just here to get an A. He wanted to know everything, and maybe he's interested. And so lo and behold, Camille and I connected, and I didn't think I was going to be able to get him to leave because he was at CRI, which is $350 million firm. And I remember him being like, no, I like it there. I was like, in my head being like, dang it. But unintended events that happened within CRI kind of pushed Camilo to leave, and it's been a joy ever since. So
yeah, I get to do a lot of things that I enjoy, which is the research aspect of everything and staying up to date with tax law and ultimately figuring out how to give less of our hard-earned money over to Uncle Sam.
Yeah. And I will say this, what's also cool is Camilo comes from a Hispanic background. So it's been really cool to see some of our business owners that English is their second language.
Mm-hmm.
And Camilo obviously can communicate on a deeper level and understand on a deeper level. And I've really enjoyed that too. We've gone to a few events where they've been the Hispanic business owners at, I think it's EO, which is the Entrepreneur Organization event. And it was fun not to be like, okay, what's this white guy doing here? It's like, no, Camilo Rojas. So I fit. But yeah, so I think that's pretty much us in a nutshell.
No, that's great. And so, yeah, hopefully people get a taste for, hey, we've got a well-rounded team here. And, today specifically, we're going to be talking about something that, most weeks it's going to be it's not going to apply to every solopreneur, but I feel like today really can apply to everyone listening because it's all about the mindset shifts that they need to make. Hence, in the title, I put, the 7 tax mastery mindset shifts that every solopreneur needs to make. And so we're going to start walking through those and just jumping in with number 1, and that is aligning the goals of the solopreneur with the types of tax strategies that they're going to be applying. So maybe we'll start with you, Daniel. When you're advising solopreneurs, how do you help them align their tax planning with bigger goals like legacy or lifestyle, not just with saving money?
Right. It's one of those things where it's got to be goal driven and it's got to be something that's authentic to the taxpayer. So there's plenty of strategies out there. We'll have people, and Sam, you've been on several calls where it's almost like the first thing they ask is, well, tell me some advanced tax strategies. Tell me what you know. And I think that question is flawed in a way because it doesn't get down to the real depth. It's almost like asking a doctor, tell me a medical procedure that you know about. I can tell you that, but it's not applicable to you. Do you need the procedure? Probably not.
Right.
So it's more about focusing on, look, these are my pain points. Yes, I want to lower my taxes, but how can I do that in a way that builds wealth? That's essentially what tax planning is just mitigate tax and build wealth. We're not just mitigating tax to mitigate tax. We could do that by telling you to, purchase all this equipment and depreciate it. But that may not be what you want to accomplish. You lowered your tax bill, but you also lowered cash flow. Maybe you added debt, and maybe that actually doesn't fit what you're trying to do. That could work for somebody that is trying to build a construction business or something like that. But for the taxpayer, we really got to dig in deep and say, okay, do you have concerns about retirement? Do you have concerns about the diversification of your income streams, right? It could be, yes, I want to leave money to my kids, or I just want to be able to mitigate tax and maybe optimize a little bit better in my business. Like a better question would be, what are some strategies that are applicable to my situation, which we would need to dive in and understand, well, what's the benchmark? What have you been doing already? And there's some hurdles there too. There could be great strategies for you, but if cash flow is an issue, it can be really hard sometimes to mitigate your tax without putting your cash in specific instruments and things that the IRS has condoned as, hey, these we want to encourage people to do. And as such, we're going to give them lower tax rates or tax-free results in that, but you got to have a reasonable amount of cash flow, right? I'm not saying if you don't have $1 million, we can't do anything for you, but realize there's a tug and pull there. So that's kind of how I would approach it with tax planning and strategy. Is it's not enough to give you a huge list. And that's why the library is locked, right? It's like, we want you to go through the steps first and really understand. The better educated you are, a business owner, and also potentially a client or current client of ours, the better we're going to work together, and the better you're going to understand the philosophy of tax planning, and knowing that it's not simply just cut my taxes down so I don't have to pay Uncle Sam. It's how to be tax efficient and build your wealth in a smart way.
No, I love that. And I mean, I think that's just a perfect first mindset shift to make. Is it's not just about cutting back the taxes, but what are your goals? Because that's going to determine which kinds of strategies we use. So
Right.
I
And
love
we've had
that.
people they're in a corner and they're like, goals, I don't care about goals. I just want to lower my taxes. They're not even in the right mind because there's too many pain points. There's too much stress going on. So we got to first move out of that before we can reasonably think about, okay, how to efficiently do things. And I'll give you an example. We have a solopreneur. He's kind of in that situation. And one of the things he mentioned was, yeah, I've been putting a lot in my Roth, or as much as I can in my Roth. And we're like, hold on a minute, why are you doing that? He's like, well, my financial advisor told me to do it. It's not bad advice, but the pain point was taxes. And so to me and to Camilo, it just made more sense. You're going to be putting that money into your Roth, and it's not in your 3-year horizon to build your Roth investment. Your pain right now is taxes, and you're trying to save on cash flow because you want to buy a new house. So why don't we instead stop doing that for now? We can always look at Roth conversions later and strategically place those. Let's focus on retirement deferrals, your 401k and a profit sharing versus doing that. Because again, it's not saving on taxes. You put $7,000 in your Roth, your tax bill is still the same, but you have $7,000 less in cash to pay your taxes. Whereas it makes more sense in a higher income year to defer versus the reason why people say, do the Roth, do the Roth. Your future self will thank you later. But if your current self can't ever catch a break, it's not really going to matter all that much. You have problems now. Let's focus on the short term and fix those, and then we can get better on our long-term goals and settings. So we pushed him to shift into doing the deferral investments to lower his tax bill. Now he's got that 7,000 put away, but guess what? His tax bill just went down less. So he's just being more tax efficient in this high income year. Not.
Yeah, I think that's so smart because thinking about in the future too, there are other strategies to offset those Roth conversions, like you were saying. So it's not the end of the world as far as you're not going to have the best tax treatment later. Obviously, to get those benefits now, that's why you would do something like
And I
that.
would say sometimes financial advisors can be like, well, you're going to have to pay tax on those Roth conversions. Of course you will. That's true. But
Always.
yeah, exactly, exactly. And that's the thing. They don't see that because they're not tax advisors, right? If you have a dramatically low income year, that might be an opportune time to do a Roth conversion. If you have losses in a year in your main business, that's going to be a great opportunity to do a Roth conversion. But then there's several different other things that we can do to convert your deferrals to Roth, including a simple fee donation, gas TPP investments. There's real estate investing, depending on, as long as it's active, that also can help. There's a lot out there, but I understand the caution of a financial advisor, but they are advising based on not leveraging those types of strategies and those timings. They are aware when the market goes down, that's their lever to say, hey, let's convert because your portfolio went down. And so when it goes back up, it's going to be in a Roth. And that is a great strategy in itself too. But that's the only thing they focus on is your to do a conversion would be really high. So there's just a lot to do. For sure.
I'm hearing you already start to talk about some of these strategies because I feel a lot of people listening, they really want to hear, okay, what are some of these strategies that we can be using? And on mindset shift number 7, we're actually going to deep dive into some of those and the different ways to save, what some of those strategies look like. So make sure you're sticking to the end here. But let's go ahead and jump into mindset shift number 2. And Camilo, I could use your help with this one. But this is about the difference in risk and tax law, people who are crossing the lines and under, a lot of entrepreneurs, they worry about crossing the lines with tax strategies. So how do you distinguish between aggressive strategy versus risky behavior? This mindset shift for solopreneurs.
I think there's a lot to unpack there, and I'll start off with a study that was done by Miles actually, and it focused on the mentality that large corporations have with tax and then small businesses with tax. And what study found was that large corporations, for the most part, their focus is not necessarily mitigating that tax. They know their accountants will do everything that's legally needed to get it as low as possible. What they want is to reduce interactions with the IRS. They want to focus on the day-to-day business that they're running and not in having to put dollars to defend a position or to try and argue with the IRS, much less take anything to court. Whereas the smaller the business is, the more that the focus is on trying to be overly aggressive and get that tax down. And we hear it from a lot of potential clients. They come in and say, can you get me to pay zero tax? Well, the answer is yes, but do you have what's needed for it? And does it actually make sense for you? The answer is almost always when you tell people how to get to that zero tax, they're like, no, I don't want to do that. And so that's one of the biggest differences. And I would say it is important to understand that these so-called gray areas, they don't exist. They simply don't. Tax law is tax law, and court cases have established everything. That means court cases have established most of the scenarios that we actually come across. Gray areas in reality are just aggressive positions that taxpayers have taken that the courts have not ruled on yet. Give it a few years and they won't be gray areas anymore. So I think that's one of the biggest ones. And as far as the risk of it goes, there are strategies that are riskier than others in the sense that you might have to interact with the IRS. However, if you're documenting everything properly and you have your clean books and you have your justifications for why you're doing what you're doing, there is no risk. I mean, if you're doing things legally, the IRS can look at it and they're going to come to the same determination. It's okay, yeah, you followed all the procedures. So it depends on how you define risk. Now, if you are trying to get cute with things, I'm going to purchase this and it's got nothing to do with my business, but I'm going to run it through my business. And what's the risk? It's $400. I mean, what's the real risk? I think it's kind of silly to get the benefit of $110 at best, to take on the risk of the IRS all of a sudden wanting to nitpick through your entire books if they find this one thing, right? I don't think that's worth the time, nor are you really sticking it to anyone, which is what a lot of times tends to be the goal.
Gotcha. Yeah. I know it sounds like there's kind of, you see a lot of the extremes, right? Like people who are just very aggressive and it's okay. They're probably not going to notice. And then other people who get a little, I don't want to cross any line. I don't want to have to interact with the IRS at all. What would you say to someone that's kind of more on the timid side of they're not taking as many risks or anything? Not that it's risky, because you said there's not so much a gray area. It's just they don't understand the law. But how would you kind of
Right.
guide that mindset?
Well, I think it's completely okay. We have a client that we saved him plenty of money, I think well over $1 million. And we proposed an additional strategy, and he just did not really want to do it because it's a strategy that gets audited 100% of the time. But if that audit comes back clean, what do you care? Well, as the accountant, I don't really care. As the taxpayer, he did not want to have the headache of dealing with the IRS. And that's completely understandable. But again, he had implemented other strategies already. So if you're sitting on the fence for every single strategy, you need to know that you're not going to be saving anything. You do have to implement the strategies. But if there's something that's just uncomfortable for you, that's also okay. There's other strategies to look at.
Yeah, that was the way you said that, like you have to actually implement the strategies. That's perfect, because that's what point number 3 is, that a lot of solopreneurs, business owners, this mindset shift of realizing, some people don't realize that there isn't the investment piece, that you have to actually implement them. So I guess my question, it could be for either of you, whoever wants to take it, but why should solopreneurs think of tax planning as an investment and not just an expense? Yeah, we're talking more about how implementing strategies builds wealth. It's an investment, not just an expense, right? Some people, they get caught up in, oh, it costs a certain amount or whatever. And I'm wondering how we can help people understand that tax planning is an investment.
I will say the lower tax you pay, the harder it is to see that. Right. And that's why we tend to say, look, if you're paying 50,000 or more, that's who we tend to work with. Right. For people paying less than that, I always see them more. I paid my accountant $1,200 last year. But your accountant was a historian, wasn't doing proactive planning and really diving into it. It's not the same. You're comparing an orange to orange juice. It's different as far as what you're getting and the work you have to do versus what the tax planner is doing. But overall, I would say it's one of those things where you have to have an analysis done. You got to really look and see, okay, is this planner going to help me get to where I want to go? And can I lower my taxes? So let's just say your planner cost you $5,000. If they're able to save you 25,000 in taxes, maybe some of those strategies did require you to put money away or invest in certain things. Maybe a little bit was about efficiency, like utilizing the Augusta rule if it applied and being able to get some tax-free money that way. All in all, you might be out in cash flow 30, 40,000, but some of that cash flow is actually in wealth building strategies, right? So some people think, okay, I'm going to pay you 5 grand and I'm going to look at my taxes come tax time and I'm going to owe 20,000 less. It's like, it's not that easy. There may be some things we can do, like QBI deduction, for example. We had someone where they were not structured correctly to fully take advantage of the qualified business deduction. So it was, I don't know what that deduction ended up being, but it was
Significant.
and so there's stuff like that. And we always hope for that because that's an easy one, right?
We were talking about that 2 days ago where we don't even consider QBI a strategy. We know a lot of people mention it and there's a lot of talk about it, but there's things that we think is just common sense that and you've been talking about planners, but most people don't have a planner. Most people have a filer. They have their accountant that files their taxes. You interact with them once, maybe twice a year. They tell you to write a big paycheck to the IRS and that's it. That's not what a planner does. So we see things differently. Yeah, I have 2 kids. Well, guess what? You probably have a child tax credit somewhere in there. We don't consider that a tax strategy. That's a given. You have a child. If you meet the requirements, you have a tax credit. We're not going to come up and be like, hey, we just saved you $2,000 in a credit. That's ridiculous. So
I will say estimates too is a part of proactive planning in the sense that a lot of times you're given these vouchers, you pay the vouchers, you think you're okay. But those vouchers are based on the past. They're not even looking at your current income. So maybe your income took a dip. It's like, hey, you don't have to make that high of a voucher payment and we can lower your cash flow that's going to the IRS and giving them an interest-free loan. Conversely, on the other side, there was a prospect client that was paying $1 million in tax. And we saw if we just simply did proper estimates with this guy, we could save him $50,000 in penalties and interest just by doing one thing.
Wow.
Like proactive and analyzing the profit and loss in the balance sheet on a quarterly basis. And instead of him using prior year adjustments, prior year financials and vouchers. And also I think his current accountant was saying, hey, you probably should make an estimate here and there. Now it's under the discretion of the business owner to make those estimated payments, but they're so crucial as far as not overpaying. Some people will say, I need that money. I get it. I'm going to be borrowing from myself, but we have to do this. But ultimately, if you are borrowing that money, you better be getting a 10x 5x return instead of paying interest on your taxes. It makes no point. And the more taxes you owe, the higher those penalties are, right? So even somebody owing 50 grand in tax could be paying over $1,000 in penalties and interest, which is an inefficiency when it comes to their overall tax planning.
Gotcha. No, I'm glad you brought up the quarterly tax estimates and how that can be such an important little lever to help people save so much. So realizing these strategies, they help you build wealth, and it's specifically through a tax planner that's going to proactively find strategies with you and help you implement them. That's going to help you get there. But I think a lot of people struggle with this cost resistant mindset as a part of this, right? They get so caught up in, well, what? I have to put money forward to be able to save the money. Does it cancel out? But I don't think they're necessarily seeing the bigger picture of how it is an investment. Is that right?
Yeah, and I think the best way we can kind of articulate that is through examples. For example, we have a client who's now finalizing 2024 taxes with their tax preparer. He paid us, I want to say $10,000 to do tax planning, right? Quite an investment, but he was going to pay probably close to 150, 160,000 in federal taxes alone.
Dang.
So one of the things that, you look at the overall makeup of this person, veterinarian practice, owns his own commercial building for the veterinarian practice. That's owned under a separate LLC partnership that him and his wife are managing. And then he has the veterinarian practice as an S corp. He's got great QBI. One of the things we saw was, well, your wages are really high. I think it's reasonable to lower that a teeny bit to save you on some payroll taxes. That probably saved him 2 grand. Okay, I wouldn't say that's worth the investment. Next thing, hey, do you ever do meetings at your home? No. Could you? Yes. Okay, well, let's implement the Augusta rule. He was able to do meetings. Now you got to follow specific procedures. And this only really qualifies for people that have a separate office. He's able to do meetings, document those meeting minutes. He did additional 5,000 in deductions, and that 5,000 is tax-free under his personal taxes. Okay, so there's another amount that you saved. Then we looked at his commercial property. Well, he's paying a good amount towards that, and he's netting some money. It's a deduction on his business, and then it's income on his partnership all flows into him. Well, one, let's up your rent to a more competitive rate. And so now that deduction is bigger. Following that, let's do an engineering study to accelerate the depreciation on that property. Well, what that did, now we had to hire an engineer, it was a couple $1,000s to do that. But what that did was there was probably $40,000, $50,000 in income that was completely wiped out by the depreciation. So he didn't owe any money from the cash flow received from that business. And then following that, he decided to do a simple fee donation, which again, specialized donation. They get audited 100% of the time because the IRS hates them, but they are legal. And you have to be partnering with a syndication that knows exactly what they're doing and they're following everything and they're not abusing those donation valuations. He did that. That saved him another well over 100 grand, I believe, in deductions. So ultimately, he ended up going from probably owing, I would say, $60,000 in taxes to get it to having an overpayment of 43,000, right? So really
with
great.
a carry forward donation of about $20,000 for next year as well.
Yes. So he's in an amazing spot, right? He's completely avoided underpayment penalties and interest. And there were other strategies we went over with him, like defined benefit pension plan. Wasn't a good fit because he has employees. He was looking at compensation deferrals, which really aren't really that great anyways. And it was over complex. Oil and gas DVP investments we looked at, probably will consider that for next year. There's so much there, but you can see how that saved him. Overall, yes, he got that refund. But overall, we were conservatively estimating about $110,000 in tax savings. Now, was that worth the $10,000 tax planning fee? Absolutely.
Yeah.
If anything, we should have charged more. But
exactly.
Regardless, we like to focus on conservative numbers. I would rather feel like, man, I should have charged them more and then get such an amazing return versus, hey, we only got you 10,000 in savings and you paid us that. That wasn't a very good investment.
Right.
So that's the point, and that's the approach that Camila and I always have is like, can we find 3 times ROI? And if we feel we can't do that, we'll refund their money and just focus on the basics until we're in a position to actually do some great work for them.
Right. Wow. I can just hear solopreneurs, business owners, ears perking up. And oh my gosh, all the strategies you just mentioned there, this is just gold. So yeah, if they're not working with a tax planner yet, where are you? We're ready to connect. So, but let's go ahead and jump into we have a few more of these mental shifts, and there's just going to be continued gold in it, especially in number 7, I was saying. So, but number 4, we're on the tax mastery mindset shift that solopreneurs need to make is being preventative. The damage is already done for the past, and I just want to hear you guys talk a little bit about this. You say that after the fact, the damage is already done. So what do you mean by that? What does that translate to?
A lot of times, clients will come to us and say, hey, mind you, we're in 2025. So this is a very up-to-date example. And they'll come, hey, I have these taxes from 2023. Can you help me? It's like, well, that's 2 years ago. The answer is almost always no, because you've already done everything. You took actions. Taxes don't magically happen. Taxes are a reaction to your actions. So what we would do is we take the facts from that year and we present them in the best possible way to the IRS. But we can't change the facts, and those facts can be limiting. That some things can only be treated one way. If you had an S corp and you took out a loan and then you took out money from your S corp and you gave it to yourself, you might not want to hear this, but you've exceeded your bases in many cases, and you now gave yourself additional taxes in the form of a capital gain. So when you come to us after the fact, our hands are fairly tied.
And I would even say, let's say someone says, hey, I just did this. I just purchased a house, or I just invested in something. And you did what? Wow. You got to give us some forethought here, because it's really hard for us to fix maybe a mistake or at least be informed, right? As far as, look, you can dive into that investment or do whatever you want to do, but at least be well informed of the tax ramifications, because 9 times out of 10, I feel a taxpayer will be like, well, I would have probably approached that differently had I known the tax consequences of that transaction. Exactly. So ask first. People get so caught up in, oh, well, I want this now. They don't see the ramifications of specific things. The other thing too is that for the past, there's possibilities of amendments. We have done them. The problem is that it takes a lot of time. We want to make sure, okay, like we had a wonderful client of ours last year was like, hey, I need my 2023 tax return amended. And we determined, yep, we can reasonably amend this. But you're basically at the mercy of the IRS. It's been a year, and we met with them yesterday, and we're like, oh, it looks like they're finally processing the amendment. We don't even know the results yet. Our hope is that it's going to lower his taxes by 50 grand because there were a lot of missing deductions. But you also someone has to physically at the IRS look at this tax return. So I can't make these things go away, because ultimately the person that has ultimate authority and control is the IRS and the taxpayer. So it's better to have all your ducks in a row and file just once. Otherwise, when you amend, you also open up that audit period too. So keep in mind that that's also a risk there. I do know of a lot of practitioners that say, have us review taxes and we'll amend. We've amended thousands of returns. But what they don't realize is they're also opening the risk of all of these audits, because the IRS looks at like, well, if this one was wrong, how many others are wrong? Right. And then the other thing is the timing, and the fact that I can amend a return and say, hey, I need a refund for 10 grand. The IRS could say no for some reason. And in this scenario, they actually sent this client a letter saying you need to provide additional support. Otherwise, we're just going to miss out. We only had like a few days, because by the time they gave us the letter, we were like, oh, we got to scramble. They're looking for any reason to not give in and process the amendment and give the refund. So just be aware of that. We hate working with the past. We love working at the past when it comes to understanding the client and how we can get better from there. But, it's really rough when someone's like, please amend my return and give me more money. We can't fix that. If there's opportunities, Camilo and I will be like, yes, this is the opportunity. We can get you, 5 grand back. Do you want to do it? Boom. But 9 times out of 10, it's just better to focus on your future.
Yeah. No, that's cool.
And every time you do that, like every time you have that amendment, you are extending the window in which you can be audited, right? And so we talked about the risk of having, the positions that you take on the tax return. And I said, there is no real risk if you've documented everything and you've done everything the way you're supposed to. However, when you're amending something, you're saying that you either forgot something or you did something wrong. And we can stand behind our work, but if we're amending something because it was done by somebody else, the likelihood of there also being things that are miscategorized, improper treatment, that's relatively high. So when you talk about risk, I would say that is one of the scenarios where risk actually does exist.
Yeah. Gotcha. And that actually happened to me early on. The books for a client were in shambles. And once we corrected the books, I was like, we really should amend this. And we amended it and it was fine. But one thing that was off was the shareholder basis was never monitored. And I think they had other things that really flagged the audit, but they got picked for an audit, it was stressful, but luckily the auditor was actually really easy to get along with. She saw the books were clean and that they had been reconciled. The only issue was that this taxpayer took on too much debt, had losses, and had increased their basis by some error of 5 grand. They owed a capital gain. Maybe it was 20 grand, because I think they owed about 5,000 additional taxes. And since then, I've always been just furiously alarmed if somebody gets too close to their basis, because I know that is looked at. And there's a reason why you have the 7203 form these days, because the IRS a few years back realized nobody's really monitoring their basis. We need to require them to do so. So
could you explain that real quick, what you mean by their basis?
Sure. So shareholder basis is essentially just your skin in the game. So basis can be increased by 2 things: contribution, so money you put in, and net income from the business. And they're decreased by distributions, losses. So in the case of an S corp, partnerships can be very different because debt can increase basis in a partnership. So with that said, this is mainly the problem with an S corp, which is what this business owner was. And honestly, they weren't ready to be an S corp. I remember also looking at it and being like, why did this guy create an S corp for you guys? You haven't turned a profit in 3 years. Kept it as a Schedule C until, and that would have decreased the likelihood of basis being a problem. You still have to monitor basis in any business that you have, but it would have been less of an issue, I think. And with that said, this person took on too much debt and had losses. And so not only are those losses suspended, they can't take them, but if you take some of those losses, no contributions where you shouldn't have, you can take some of those losses to offset your income. And that's what this scenario was, is that they had taken some of that debt to use personally. And that in an S corp is a capital gain. So, which is taxable. So super important that you understand that. You understand a lot of these business owners, the business is an extension of how they fund their life, right? Like they have a net profit and they're like, all right, maybe they pay themselves a salary, but then they do a distribution periodically. You take out a loan and then net profit starts to go down and then you use the loan to fund personal expenses, it could be detrimental.
Yeah. Awesome. I think, wow, we talked about being preventative, but I feel like you also already covered point number 5, the mindset shift of consult before you make those big decisions.
Yeah.
In the case of being an S corp, right? Kind of understanding, is it the right time, right? Or just the other decisions that you talked about in those examples, those kind of go hand in hand. So let's go ahead and jump to the 6th mindset shift. We only have
before
2
you
left.
do that, there is one point to consulting before big decisions.
Please.
Be sure that whoever it is that you're working with is aware of your long-term goals, because a decision might be bad for the short term, but it could be good for the long term. And if your goal is a long-term goal, then your accountant can make sure that it's being prioritized. So just being very clear with what the goal is, whether it's from the business perspective or from the personal perspective, as far as retirement accounts or anything similar, let your accountant know.
Yeah, I'm glad you mentioned that. And that ties back to the first point of just understanding your goals. And so make sure as you're consulting over those decisions, making that a part of the equation. I love it.
Absolutely.
All right. So point number 6, excuse me, is being cash poor makes it hard to save on taxes. Okay. There's a mindset shift of, well, if I'm cash poor and I don't have a lot of money, are there still ways that I can really save on taxes? So let's talk to this. Why is it so important to have cash to be able to save money on taxes?
Yeah. So cash is going to be important for so many reasons. One, you got to have a good, stable position when it comes to your cash flow. If you don't, it pushes people to either do something unethical or it just pushes them to not be able to do anything. So I could say, hey, if you put more money into your SEP IRA or your 401k, that's going to save you 10 grand in tax. Well, I don't have that cash flow. Okay, well, then it's not going to help, right? But what happens is some of these people that I've worked with where they're just unable to do it. And so it just makes more sense for them to pay 10 grand in tax instead of put 30 grand away, because they still got the 20 grand in cash that they can use for other things. But when you look at it, okay, yes, that's true. But if you were able to put 30 grand away, you just upped your wealth by 30 grand and you also lowered your tax bill by 10. So you're better off that way. But if somebody can't do that, or somewhat meet in the middle somewhere, you're just constantly going to be paying a tax bill, and that cash flow is going to be used for other things that do not build wealth usually. And so that's the cycle that needs to start stopping if you want to start getting ahead. So I would say, like, I had a client, he's a realtor and doing very, very well. And we did a few things like hire his kids, and we did the solo 401k with the profit sharing. But that only saved him about 13 grand in tax. And I was like, really? I think he had 400,000 in treasury bonds, like really conservative liquid investments. I don't even think they were bonds necessarily. I think they were something else that was even more liquid than that. And he just hated the idea of putting 50 grand into oil and gas TVP investments because I don't think he really understood it. And which is, I think, on me as a tax strategist I need to get better at maybe explaining those things. But ultimately, even if he understood, he probably might have not wanted to do it. But it prevented him from saving closer to, I would say, 30,000 or more in tax savings with the combination of both those strategies. And so he was more okay with just doing estimates at that point. But I do think ultimately that was somebody that is almost, I just want to hoard cash. If you want to hoard cash and not invest and do things, you're just probably better off doing tax estimates and that's it, right? To mitigate your penalties and interest. But realize your is going to be worth less and less every year. So you really do need to look at investing just because of inflation, right? Especially for the last few years, we've had this huge shift in inflation that is finally starting to look like it's tampering down. But that's why interest rates are so high, right? Because for the longest time, interest rates were low. And so he's missing the point. I had another client who did oil and gas DPP investments. And as we were yesterday reviewing his taxes, I was mentioning, oh, we saved about 30,000 just by doing the oil and gas DPP investments. He's, oh yeah. Now, speaking of which, I just got a check for $4,000 from my oil and gas DPP investment. That's have that kind of scenario where you're building wealth and you're creating opportunities to create more income streams for you, right? So this is somebody that obviously is a very successful business owner. And so he was able to take that risk. But now you can see just the income streams are coming in. And it's better to have multiple types of income streams that are tax efficient versus maybe only having one or two. And that's what tax planning will really push is, hey, let's lower your stress, build your wealth, and mitigate tax. And if it all aligns with your goals, you've got a wonderful tax plan ahead of you.
And when we talk about cash poor, it's not just the person that has $3,000 left in their bank account, because that absolutely is cash poor. You can't ask someone that has 3K in the bank to invest $50,000 into oil and gas. They're going to think you're crazy. But at the same time, you could have 100K in the bank and you want to buy a $60,000 car cash because you don't want to take on debt, and then you want to take a $20,000 vacation. Well, in our eyes, that is still cash poor, because you have the cash sitting there, but you have it earmarked for essentially pleasure. And what needs to be understood is that favorable tax treatment is given by the IRS when they want to encourage specific activities from individuals and businesses. And that tends to be geared towards the future. If the idea is to have your cash, keep it, and just enjoy it, there's no tax treatment that's going to benefit you there. There just isn't. And because you mentioned the oil and gas, when you are cash poor in either one of those two senses, you tend to be cash flow sensitive. So if we say, hey, $50,000 investment is going to save you, if you're at the highest end, $16,000 in taxes. The potential client can come back and be like, are you crazy? You want me to pay $50,000 to save 16? That doesn't math. It's like, well, it does, because you didn't lose $50,000. It's still your $50,000. It's just put away in an investment that's going to be paying you out for the next 10 years. And it's going to give you a return. And on top of that return, you're saving $16,000 in taxes today. Yeah. So, it really is one of the best strategies out there, and still surprises me how many people don't see it that way.
Let's say, for example, somebody is kind of cash poor, but they're at the age where they can distribute money out of a retirement account without penalties. They could get the 50K there and invest it in oil and gas. And then they are the general partner that first year. And so they're able to offset typically 80% of that investment, right? So they're getting really good.
That's the conservative number.
Right. Yeah. And I think last year we saw 87% was the write-off, but they're getting that write-off. And then the following year, that income is going to be limited. So it's not going to be subject to self-employment taxes. So you're getting the best of both worlds. So there's a lot of different angles you can go about it. But ultimately, like, you just have to have in your head that, look, it's going to require investment in some way or form, both in hiring a tax planner and also moving your chess pieces in a way where you can beat the other side, which is the IRS. And I don't mean that in a malicious way. It's just more play their game, right? They've given you the playbook of where you need to position things. You need to make sure that you know how to play that game.
Exactly. And that's why we're here too, and why we're doing this is to help you understand how to play that game and to do it in the best way. And without these mindset shifts that we've been sharing, it's going to be a lot harder of a game to play for sure. So, but yeah, I think this goes perfectly into our last point, understanding that's an investment, that you can't be cash poor, right? And then really understanding that this is our seventh point here, that there are four main ways to save. And we're going to jump into those four main ways to save, including some of the strategies under each of these umbrellas. But losses, deferrals, income shifting, and investments being kind of the main ways that we save. A lot of people, Camilo, think that it's just checking off a box. I'm going to work with a tax planner. Can I just check off a box? Can you explain a little bit more about shifting that mindset and how they should really be thinking about this?
Yeah, it generally just doesn't happen that way. The only thing that you can check a box is there's PTET, which is the pass-through tax selection that you can make. That's literally checking a box and paying your taxes through your business instead of personally. And it gives you a credit depending on the state. It's dollar for dollar. Some states it's 80%. It varies by state. And then you have small things, child tax credits that we mentioned again. We don't consider that strategy. Workers' opportunity tax credit does not require any sort of cash flow, but it's not a box. You still have to do something. You have to implement a process in your hiring phase to be able to qualify for it. You have the Augusta rule. Again, it's not that simple. We actually just had a client that implemented it perfectly. I'm trying to see if they'll let us use this as an example because it was beautiful. I was so happy, and I know people are going to think I'm crazy, but I was so happy when I saw the documentation they provided us. It had a comparison for 3 other locations right close by. It had the pricing, it had the pros and cons of each one. It compared the atmosphere inside, the decorations, everything. It was beautiful. And they were able to have a reasonable hourly rate for the events that they were holding at their home. And it was great. So it still requires work. The idea of I'm just going to check a box and all of a sudden I'm going to get a refund from the IRS. I know there's a lot of social media influencers that make it seem that way, but tax doesn't work like that. So it's not a thing.
Yeah, no. Thank you, Daniel. Any comments about these four main ways to save?
Yeah, the pinnacle, there's just hundreds of strategies out there, but they all treatment of those 4 pillars, right? The deferrals, the deductions, the losses, the investments. So it's really important to understand that. But at the end of the day, it's not about advanced strategies. It's about what strategies will mitigate my taxes, are applicable to me. There's hundreds of strategies out there, and there's probably hundreds that won't apply to your situation. But if we can find 1 to 5 strategies in a given year that apply to you, it could be powerful. And that's typically what we see is that it tends to be 3 to 5 strategies within 1 year. And then the following year, it could be 3 to 5, or it could be less, but they could be different strategies than the prior year. Some of them could be still strategies we're using. It doesn't really matter how sophisticated or how simple. What matters is the result. And if fits your situation and it meets the end goal, then you're in a great spot.
And we can give a couple of examples here because we said we'd give you some specifics. So the 4 categories themselves. First one is losses. You have deferrals, income shifting, and then investments. Those are the 4 major ways that you're really going to be saving in taxes. So for the first one, losses, it's pretty self-explanatory. It's actual losses or it's paper losses. Now, the IRS defines losses based on your profit, your income sheet, not on your cash flow. So if you purchase a house that's rather expensive and you're out a lot of money and it's going to be a rental property, that's not a loss. That's just negative cash flow. The losses come from the deductions that you take. With real estate, it's generally going to be depreciation. So one of the ways you create losses is through that cost seg study that you can perform. It has to be a short term to actually be useful to you. Now, if it's a long term, you can combine those passive losses with the passive income from another strategy that falls under the investment category. And that would be oil and gas starting in year 2. Because year 1, you're active. But starting on year 2, you're passive. So if you put those 2 together, they actually work very well together. Your next bucket is deferrals. And this is where some investment strategies also fall under. So like your typical retirement accounts would fall under deferrals. Then income shifting, there's 2 really simple ways to do income shifting. The one that everybody talks about is hiring your kids. There's a second level to that, and I don't know why people don't ever consider it. But if you have parents that are retired and they're making very little from Social Security, hire your parents. Even if it's not totally tax free, it's probably at a lower tax bracket. If you're taking care
Yeah.
of them or live with them or anything, it's pretty beneficial.
All right, Grandma, you need to file some paperwork.
There you go. She could be a caterer, right?
Yeah, there you go.
And the other one is by layering different entities. Like you could have a business that owns where you work as far as the building. And so you can do that shifting again to combine with something like a cost seg or with additional expenses like the property taxes and anything else related to it that would actually create a loss there. Or it just nets out to zero. And then that's a deduction that you took on the original entity. So these are just some basic examples. Again, we don't consider any of these advanced strategies. All of these are simple. They're pretty straightforward. The complexity comes in how you document.
Yeah. And then I will say lastly is understanding the new tax bill that just passed, right? That will play into your tax plan anyways. So it's important that you understand how that's going to mitigate your tax, right? The standard deduction went up, but then also itemized deduction treatment is very different for this year and going forward, which is really exciting. But anyway, I think that's pretty good summary though overall. Sam, you want to take it away?
Yeah, absolutely. Thank you guys. This was incredible. I hope those of you listening really understand how important each of these shifts are. And you got some golden nuggets, some great takeaways from specific strategies that we shared today, as well. I mean, as well as just that mindset shift and how it's going to help you ultimately save more in taxes. So that being said, if you want a full list of these, we actually have a free resource on our website, which we'll include in the show notes, but it's the 7-Figure Solopreneurs Tax Playbook. And we list out, first of all, the 10 most important strategies that you should be implementing. We don't refer to them as strategies necessarily, but the first 10 steps that you should take. And then we have a list of all of the strategies ranked from not as much of a cost to these advanced ones. So if you're someone that wants to look at that list, get it. It's for free on our website. We're not here to gatekeep in any way. We just provide as much value as possible. And if you want help actually implementing these things, then please schedule a call with us, which I'll also have linked down below. But we just want to thank you guys so much for joining us today, and we will see you in the next episode.